Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. And while at my website, click on our podcast page to check out our past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. All right, so today we're talking about one of the most underused tools in personal finance, health savings accounts, or what we call HSAs. And specifically, we're going to dig into the tax advantages that make them so valuable, not just for covering health costs today, but potentially as part of a long-term financial strategy. So for the first part of today's conversation, we'll be drawing from a Fidelity article titled HSA Triple Tax Advantages Explained. And then later in the show, we'll be pulling from an Investopedia piece called Understanding Health Savings Accounts, Benefit Rules and Limits, which covers some additional groundwork that's worth knowing. All right. And as usual, I'm very glad to have my co-host, Tony Shore, here with me today. Tony, how you doing, my guy?
I'm doing great. I've had a great week. We were talking before the show. It sounds like, Albert, you've been really, really busy, haven't you?
Yes. Yes, I have with the summer, as you know, and it's not all work, but personal and work. Been very, very busy, but
Yeah, it's
you
good.
know what? That's just the name of the game, right?
Yeah, it is. It keeps you going, keeps you out of trouble. I know you've been meeting with a lot of people, so that's awesome. And
Yes.
this topic is a good one because, a lot of people have an HSA through work, or at least have the opportunity, and maybe they contribute a little. They use it to cover copays.
Mm-hmm.
I tend to think of it as a basic tool, like a dedicated account for doctor bills. That's
Right.
what I hear from people, but I'm guessing there's a lot more to it than that, right?
There is, and as you mentioned, a lot of people do have HSAs, and mostly through work, and they do contribute, like you said, a little, but they use it to cover co-pays, which is
Yeah.
fine because that's a legitimate use. But they're often not taking advantage of everything the account could offer. And when you understand the full picture, it's actually a pretty remarkable tool. So let's start first with the eligibility. Not everyone can open an HSA, and that's worth
Hmm.
clarifying right up front here.
That's interesting. That is a good place to start because I think a lot of people just assume that they're automatically eligible for an HSA if they want to contribute to one.
Right. And you know what? That's not the case.
Mm.
See, to contribute to an HSA, you need to be enrolled in what's called a high deductible health plan, or what we call HDHP. That's a specific type of health insurance with a higher deductible than a traditional plan, meaning you pay more out of your pocket before your coverage kicks in. So in exchange, your premiums tend to be lower. Now, you can open an HSA through your employer if they offer one, or through a financial institution directly. So as long as you meet the eligibility requirements. So step one, if you're curious about an HSA, is to check whether your current health plan qualifies you.
Yeah. Well, there you go. And once you've cleared that hurdle, what makes an HSA worth paying attention to? What do we need to know here?
I'll give you three words here, Tony. Triple tax advantage. All right.
I like the
And
sounds of that.
yes. And I want to spend some real time on this because each layer of that advantage is really meaningful on its own. And then together, wow, they're generally hard to match in any other savings vehicle. So the first advantage is on the contribution side. So when you put money into an HSA, those contributions could reduce your taxable income. How that works depends on how you're contributing. So if your employer automatically deducts HSA contributions from your paycheck, well, those dollars go in pre-tax. So they're not included in your taxable income to begin with. If you don't need to do anything extra at that tax time for that benefit. In fact, it works the same way like a 401k contribution does.
Hmm. Interesting. And I think so. You're already saving money. You've already saved money by doing this even before the IRS gets involved.
Exactly. And if you're making contributions on your own with money, let's say you've already paid taxes on, well, then those contributions are tax deductible when you file your return later. Now, what may be especially nice is that you don't need to itemize your deductions to claim them. In fact, you can take the standard deduction, which is what most people do, and still deduct your HSA contributions on top of that. And then there's a bonus worth mentioning. If your employer contributes to your HSA, those dollars are excluded from your taxable income as well. So ultimately, you're getting a tax benefit on money you didn't even put in yourself.
Wow. Yeah, I love that triple tax advantage. Now, what are the contribution limits for this year?
So for 2026, the IRS limit is $4,400 if you have individual coverage and $8,750 if you have family coverage under an HSA eligible health plan. Now, any contributions your employer makes count toward those limits, so that's worth factoring in as well. And if you're 55 or older, you may be able to make an additional catch-up contribution of up to $1,000 per year. So if your spouse, let's say, is also 55 or older, they could make their own catch-up contribution. So they do need to have a separate HSA, though, to do so, okay?
Yeah. Okay, so that's layer one. What's the second tax advantage?
So the second is tax-deferred growth. Once money is inside the HSA, it could grow free from federal income tax. And that is where a lot of people leave real value, I'll say, on the table because many assume an HSA is just a checking account or health expenses. But depending on your HSA provider, you may be able to invest those contributions in stocks, bonds, exchange traded funds, and even mutual funds. So that means the money doesn't just sit there. It could grow over time and you're not paying taxes on those earnings while they remain in the account. Now, there's also a strategic element worth naming. A lot of people use their HSA as, let's say, a pass-through. Money goes in, money comes right back out for health expenses. Now, that's a valid use. But if you can cover routine health costs out of pocket and let the HSA grow untouched, the long-term compounding effect, well, that could be significant, Tony. And the tax-deferred growth layer is what makes that possible.
So, does that mean the third advantage that we're going to talk about is where all that growth pays off then?
You nailed it. Yes. The third advantage is tax-free withdrawals. When you use HSA money to pay for qualified medical expenses, those withdrawals are completely tax-free. There's no income tax, no penalties, and you could take them at any time. Now, the money goes in with the tax benefit. It grows without being taxed, and it comes out without being taxed. That's the triple advantage, and that is generally unique in the tax code.
Yeah, and by saying it's unique, you're not lying there. I read it. It is the only
Yes.
IRS tax designation or type of account that the IRS allows to go in tax-free, so it comes off your taxable income for the year. It grows tax-free, and it comes out tax-free as long as you use it for an eligible medical expense, and
Yes.
it can stay in there as long as you live. I mean, it's going to be yours to use in retirement if you want to let it save up. So let's talk about what qualifies though as a medical expense.
Yeah.
I imagine a lot of people aren't sure where the line is here, and from what I've read, it includes a lot.
It actually does. And in fact, it's a broader list than most people expect. And it includes doctor visits, specialist appointments, and diagnostic work, like let's say blood work, imaging, CT scans, MRIs. For dental care, it's cleanings, x-rays, and procedures. And then for vision care, the list includes eye exams, glasses, and contacts. So
Wow.
prescriptions, physical therapy, and hospital costs are also included. And even over-the-counter medications like cold medicine, pain relievers, and even flu treatments from your local pharmacy qualify. And then get this. Travel for medical care is one people really think about. Well, a ride share to a doctor's appointment or a flight and hotel, let's say, to see a specialist in another city are costs that can be covered by your HSA.
Wow.
So the list is generally wide, and most people have more eligible expenses than they realize.
Yeah, I would imagine so. And to learn more about this or how this fits in with your overall financial plan and retirement income plan, I know you offer consultations there. If they have questions, you and your team are great. Uh, l- uh, let's talk about that in a minute. Maybe you could let our listeners know how to get a hold of you.
Yeah, it really is one of the most compelling parts of the HSA story. So, if you really need to learn more about that, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen, and schedule a complimentary consultation. And here's why I bring up retirement in the same breath with HSAs. If you're in relatively good health and can afford to pay qualified medical expenses out of pocket in the short term, well, you could leave your HSA contributions invested and let them grow untouched for years. Now, by retirement, you could have accumulated assets designated for future healthcare expenses. And once you reach age 65, well, the rules shift in an interesting way. You could use your HSA money for anything, not just medical expenses. In fact, if you withdraw for, let's say, a non-medical purpose, you'd pay ordinary income tax on it, similar to a traditional IRA. But there's no penalty. And that means the account essentially becomes a supplemental retirement account at that point, tax-free for healthcare, taxable but not penalty-free for everything. I would say is penalty-free for everything else. And that's a lot of flexibility.
Yeah. Oh, yeah. That's a lot of flexibility. It sounds like the HSA could really serve double duty here as a health expense fund and a retirement savings vehicle, then.
Yes, in fact, that's a very good way to frame that, Tony. And there's one more feature too from the Fidelity article that's worth mentioning before we shift gears here is that the ability to reimburse yourself for past out-of-pocket expenses. So there's no deadline. If you paid a medical expense out of pocket 2 years ago while your HSA was, let's say, open, you could reimburse yourself from that account today as long as you didn't already claim a tax deduction for it or get reimbursed through another account. So the key is keeping receipts, hang on to paper and digital copies, and store them somewhere you can find them if the IRS ever asks.
Yeah. Well, that's a useful detail right there. And you
Mhm.
mentioned that we might be turning to a second source for the last half of the show. What are we looking at?
Right. Well, in fact, we've been drawing from that article of Fidelity on HSA tax advantages. Now, I want to bring in some additional context from Vistopedia's article that I mentioned at the top of the show, and that's titled Understanding Health Savings Accounts, the Benefits, Rules, and the Limits. Now, because as useful as the triple tax advantage is, there are some rules and trade-offs that are equally important to understand, and a few of them catch people off guard.
Yeah. Yeah. So let's start with the trade offs. What's the flip side of that high deductible requirement?
Okay, well, that's a fair question. So, and let's have an honest one. High deductible health plans come with lower premiums, which is appealing. But the deductible itself is real. And for 2026, the minimum deductible for to qualify for an HSA is $1,700 for an individual and $3,400 for a family. And the out of pocket maximums are significant, up to $8,500 for individual coverage and $17,000 for families. So the financial benefit of the HDHP structure really depends on your personal situation. If you're, let's say, generally healthy and have the cash reserves to cover, let's say, high deductibles when something comes up, it could make a lot of sense. But if you're, let's say, have ongoing health needs or you struggle to cover a large out-of-pocket expense, the math then looks different.
Yeah.
That's a conversation worth having with someone who understands your full financial picture.
So, what about the penalty rules? You mentioned earlier that withdrawals for qualified expenses are tax free, but what happens? Let's say if you withdraw the money and use it for something else.
Yeah, I mean, this is really important, and it's something people should understand before they open an HSA. If you withdraw HSA funds for a non-qualified expense before age 65, that withdrawal is actually subject to ordinary income tax plus a 20% penalty.
Ooh,
So that's a meaningful hit, Tony,
yeah,
not a small fine, but a 20% penalty on top of whatever income taxes that was applied. Now, once you turn 65, however, that 20% penalty goes away. At that point, non qualified withdrawals are just simply taxed as ordinary income, just like a traditional IRA. So that means the penalty risk is really a concern for the years before retirement. The practical takeaway is that HSA funds shouldn't be treated as an emergency slush fund. They're most powerful when they're used for what they're designed for, or leave it to grow.
Yeah. And not that you wouldn't have enough medical expenses to use it for that. I do like the ability once you turn 65 to treat it as a traditional IRA, and you can take the money out for anything at any time. You just if it's not a qualified expense, you just end up paying taxes on it. So then it's the same as a 401k or an IRA at that point, right?
Correct.
Yeah.
Correct.
Yeah. So are there any other penalties or rules we need to know about?
Actually, one more that doesn't get enough attention: excess contributions. That happens all the time. If you contribute more than the IRS annual limit to your HSA, those excess contributions are subject to a 6% excise tax each year until they're corrected.
Yikes.
And it's worth knowing your limit going in, especially if both you and your employers are contributing. So think about that and making sure the combined total stays within the cap.
That's a big one. I did not know about that.
Mhm.
What about Medicare? I know some listeners are approaching that age and thinking about how does Medicare affect with an HSA, and would I really still need money in my HSA if I have Medicare?
Yeah, you know what? Once you enroll in Medicare, you can no longer make contributions to an HSA. So that you have to understand. All right. That cutoff happens as of the first month of Medicare enrollment. Now, accordingly, if you're approaching 65 and still working with an, let's say, high deductible health plan, it's worth being thoughtful about when you enroll, because the moment you do, new contributions stop. Now, that said, you can still receive tax-free distributions from your HSA for qualified medical expenses after enrolling in Medicare. The account doesn't go away. You just can't add to it anymore. And as we mentioned, after 65, you can use the funds for non-medical expenses too, just paying ordinary income tax on those withdrawals. So while the account remains useful, you'll want to plan around that contribution cutoff.
Yeah. Yeah, maybe build it up as much as possible each year, and that way you can have that money in there to use, and
Yes.
it'll grow over time, and use it in to pay your Medicare premiums, pay for drug costs, things like that. Now, you touched on the FSA comparison earlier, flex savings accounts, and some people get these confused: a health savings plan and a flex savings account. Can you do a quick side by side for us on that?
Yeah, sure. So both HSAs and FSAs let you set aside pre-tax money for medical expenses, but there are some meaningful differences. FSAs are employer-sponsored plans, which means the account belongs to your employer, not you. So if you leave your job, you typically forfeit whatever's left in the account unless you elect COBRA continuation coverage. Now, an HSA, is yours. It travels with you when you change jobs. Contributions roll over year to year with no use it or lose it rule. And as we've discussed, you can invest the funds for long-term growth. FSAs generally don't offer that option. In fact, one other notable difference: self-employed individuals can contribute to an HSA as long as they meet the eligibility requirements. FSAs are typically only available to employees. So for anyone working independently, the HSA may be the better fit.
Yeah. Yeah. So I think that's really important to note. What else jumps out at you that we should know about regarding HSAs?
One that people don't think about until it matters: what happens to your HSA when you pass away?
Mm.
If your spouse is the designated beneficiary, the account transfers to them and continues to be treated as an HSA, which means they get all the same tax advantages. But if the beneficiary is someone other than a spouse, the account is no longer treated as an HSA. At that point, the beneficiary would be taxed on the account's fair market value. And for estate planning purposes, it's worth thinking about who you've named as your HSA beneficiary.
Yeah, I'm glad to hear there are a beneficiary designation on that. So you don't lose it after you pass away.
Correct.
You can leave it to your spouse. And if your spouse is no longer there, you can leave it to a child, but it's like leaving a traditional IRA. They just have to pay taxes on the money.
You got it.
It's no
You
longer
got
an
it.
HSA. Yeah. And I think that's a detail that I bet most people haven't thought through.
Oh, most haven't, really. And it's a good example of why it helps to look at the HSA not just as a spending account, but actually as a financial asset that fits into a broader plan that includes retirement and taxes and, yes, eventually estate considerations.
Yeah. Well, it just seems you can get lost in the weeds here. It's a lot of
Mhm.
moving parts, right? You've talked about contribution limits, investment options, withdrawal rules, Medicare timing, beneficiaries. Is this something you think most people can really manage on their own?
Some people can, especially if they're detailed oriented and willing to do the research. But for most people, the complexity sneaks up on them.
Yeah.
It's not that any single rule is that hard to understand. It's more that all of them interact with each other, and the decisions you make in one area, well, it could affect another. So let's say taking Medicare timing, for example. If you're still working at 64 and contribute to an HSA, the month you enroll in Medicare matters because contributions have to stop at that point. If you don't catch that, you could end up with that excess contribution and then a tax penalty you weren't expecting. Remember that 6% per year. That's
Mhm.
exactly the kind of thing a financial services professional could help you plan around.
Exactly. And I think it's probably the same with the investment side, right? I mean, that
Mhm.
seems like another area where working with somebody like yourself could make a real difference.
Yeah, it really could. In fact, a lot of HSA holders leave their contributions sitting in cash because they're not sure what to invest in, or they don't realize investing is even an option.
Mm.
So, a financial services professional could help you think through an investment strategy for your HSA that's consistent with your overall risk tolerance and timeline, because how you invest inside the account should probably reflect where you are in life. So, for example, someone in their 30s with a long horizon could afford to take more risk with those funds than, let's say, someone who has a 5 years from retirement.
Yeah. And I imagine the retirement piece is where things get really complicated, isn't it?
Yes. And that's where it tends to come together. Okay. How does the HSA fit alongside your 401k or your IRA? Are you better off drawing from your HSA first in retirement or preserving it specifically for healthcare costs? What's the right sequencing strategy for your tax situation? Now, those aren't questions with a, let's say, one size fit all answer. They depend on your income, your health, your other assets, and your goals. Having someone in your corner, though, who understands all those pieces and how the HSA fits into the bigger picture, well, that could help you better understand how HSAs actually fit within your overall financial, tax, and retirement planning considerations.
Yeah. And so to recap here, we've covered a lot. You talked about health savings accounts, how they offer a triple tax advantage. That's huge.
Mhm.
Contributions could reduce your taxable income. Growth inside the account is tax deferred. And the withdrawals for qualified medical expenses are tax free.
Yes.
And the contribution limits, just a reminder, 4,400 for individual coverage, and that's per year, and 8,750 for family coverage with
Yeah.
$1,000 catch up for anyone on top of those, anyone 55 and older. And non-qualified withdrawals before age 65. If you take something out and use it for something non-medical before you hit age 65, you're going to pay a 20% penalty on top of
Yes.
taxes. So watch out for that one. And then once you enroll in Medicare, you can't contribute anymore, and you don't want to make excess contributions because there's a 6% tax. So these are portable, unlike FSAs. I'm glad you mentioned that. They roll over
Mhm.
year to year. They belong to you, and they are transferable through a beneficiary. So good stuff.
Yes.
Why don't, before we go, I know listeners will have questions. How can they get a hold of you and your team there, Albert?
If any of today's conversation is raising questions about your own situation, we'd love to talk it through with you, put a plan together. Give us a call at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizn, and schedule a complimentary consultation so we can help you own your retirement.
Excellent. Thanks, Albert. Listeners and viewers, thanks for tuning in. And that does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care.